Wouldn't it be awesome to build a dividend stock portfolio where you knew that the stocks that you held would pay you income for life, where you invest once and create a lifetime of passive income that spits out dividends year after year and over the long term can compound into thousands of dollars. And this income starts replacing your 9-to-5 job where work is optional but not a requirement. I've been dividend investing for the past 9 years where I'm collecting more than $19,000 in dividends year after year. So in today's video, I share 2 stocks that I believe will pay me income for a very, very long term. But I also want to warn you that if you invest in dividend stocks in Canada incorrectly, it can cost you a ton of money. That's why you want to watch the very end, because I'll share the optimal way investing in dividend stocks in Canada and save you a ton of money. Just in case you're new to this, I want to get down to the basics. Now, whenever you buy stocks, you essentially own a tiny, tiny slice of a company. And just for holding onto the company, you are rewarded with part of the profit. Now, for some companies, some of these profits are paid out to you and me as shareholders as income, just for holding onto these companies. And this income is called dividends. So for example, if you own TD Bank stock, ticker symbol TD.TO, and you owned 1 share of this company, you would collect $3.84 for every share TD Bank stock that you hold. And as a percentage of the price of the stock, this would be equivalent to 4.61%. Now, the yield is simply a percentage of the income that you collect based on the share price of the stock. Now, if you're wondering how these 2 dividend stocks that I'm about to reveal would pay you income for life, it's because these 2 companies have been paying their dividends for a very long time and growing their dividends over time because their businesses grow over time.
Shout out to Moomoo for sponsoring today's video. They're launching in Canada, and they're a trading app with low trading fees used by 20 million users around the world. They are also a member of CIPF, which protects your money and securities up to $1 million.
Now, the first one is tech giant Microsoft, which had a stellar year in 2023. And I have no doubt it will have many, many stellar years for the foreseeable future, in my humble opinion. And that's because I believe there's going to be some long-term growth catalysts upcoming for Microsoft. Now, just in case you don't know, Microsoft is the direct beneficiary of ChatGPT's success and that of its parent company, OpenAI, because the 2 companies have partnered since 2019. And did you know that what's supporting OpenAI's backend is Microsoft Azure, which is its cloud platform? That's huge because ChatGPT has more than 100 million users using it every single day. According to research by Grandview Research, in 2022 alone, $45 billion was spent on artificial intelligence. It's expected to grow 39% year over year for the next decade. So with Microsoft being the top 2 cloud platform and its direct partnership with OpenAI should translate to a lot of growth for the long, long term. But of course, given Microsoft's massive rise in the past year, it doesn't mean that this stock price is at a good price to buy. So for me, I'm planning to hold onto my existing Microsoft shares, and whenever there's a big pullback, I'll definitely be gobbling more up and holding it for the very long term. And now I want to take a quick pause. Just in case you didn't know, I share one of my dividend portfolios on Blossom Social Investing app. This is one of Canada's top investing platform for Canadians. I hang out there week after week and I share my exact trades and rationale why I invest in stocks. So if you want to learn to become a better investor and follow other fellow Canadian investors, check out Blossom Social Investing app in the link below. Plus, it's free. The second stock that I would hold for the very, very long term, so that pays me income for life, is Fortis. Fortis is a boring utility company in Canada. And because a lot of their contracts are fixed contracts, they get steady eddy revenue and growing revenue year after year. So with the stable revenue, it uses it to buy more businesses and puts these businesses to work by generating more revenue. And this process has worked for decades. Now, another reason why I love Fortis stock is that it's been paying its dividends and growing its dividends for the past 49 years, and it's just shy of becoming a dividend king. In order to become a dividend king, you need to pay your dividends and grow your dividends for 50 years. So if it grows its dividends this year, then I imagine you can look forward to many, many years of dividend growth in this company, because power is an essential need. If you were to invest $20,000 into Fortis stock, this is how much income you could collect if you held it for the long term. So let's just assume Fortis is trading at $54 a share. That means you could buy 370 shares, and each share pays you a dividend of $2.26. So that means every year it'll pay you out $836. Now, if you hold these dividends for the long term and take those dividends and buy more of the same shares, which essentially getting Fortis stock for free, it could compound and double and to thousands and thousands of dollars over time. Now, as promised, let's talk about the taxation for Canadian dividend stocks. Didn't you know that there are two forms of dividends in Canada, and they get taxed completely differently? There are eligible dividends and ineligible dividends. Now, eligible dividends just means that the dividends are coming from Canadian-controlled companies. Well, ineligible dividends are companies that usually are small businesses, they're incorporated, and they get taxed efficiently in Canada. So what's the big deal? Well, the great news is that Canadian companies like Fortis are considered eligible dividends, and they get taxed efficiently. So efficiently that if you don't collect any other income, say in retirement, you could potentially pay $0 in taxes in Canada. So for example, say you sell your house when you're retired and you have a big lump sum of money, but your TFSA is maxed out, your RRSP is maxed out, and you're like, what to do with this money? And you want to collect income. Well, you could actually dump it into a non-registered account. And as long as your tax bracket is fairly low, you could potentially pay $0 in these eligible dividends, as long as they're Canadian companies. Now, of course, the other way of doing this is you could just hold these dividend stocks in your RSP, in your RESP, in your TFSA, so that they get tax sheltered, meaning you pay $0 in taxes anyway, and the dividends grow efficiently. There's a small detail. If you collect dividend stocks from American companies or any foreign company, you gotta make sure that you hold them in your RRSP. Otherwise, you'd be paying extra money to the government just for holding American companies like Microsoft in your TFSA. So for example, if you collect $100 of Microsoft dividends every single year, you have to pay $15 to the government. That's a 15% withholding fee. Now, sure, it doesn't seem like a big deal now, but over time, it can really, really big drag on your returns. Now, if you want to learn how to build a monster dividend growth portfolio, check out my ultimate guide in the link below. It's free. And if you want to learn how to live off dividends faster, then you might want to check out this video up here. Hopefully, I'll see you in the next video. Bye.